Welcome to the Deep Dive. We break down complex financial research into actionable insights really tailored for you. Today we are stepping into the ring, so to speak.
We are.
A deep dive into TKO Group Holdings Inc. That's ticker TKO on the NYSE. This is the $16 billion giant formed from merging UFC and WWE.
Yeah, and it's a really fascinating stock, mainly because it presents this, well, the stark conflict. We're doing a classic, Buffett-style deep dive using data anchored to October 9th, 2025. And while TKO definitely has huge brand power, massive contracted revenue, the stock price right now is $194.15 per share.
And that's the real hook, isn't it? Our analysis points to a huge disconnect here.
Exactly right. Our intrinsic value models, they consistently put the fair value for TKO somewhere between, let's say, $105 and $152. So that means the market is pricing in, well, near perfection, really, and maybe a whole lot of hype, too.
So our mission today...
Our mission is to figure out, is TKO a knockout investment? Or is it actually about to get tapped out by, the reality of its fundamentals?
Okay, before we dive in, just a quick reminder for everyone listening. Please like and subscribe to Stock Analytics AI, our $4.99 a month members. You get priority deep dives on every ticker.
And we're covering all the S&P 500 stocks over the next few months. Members get that exclusive priority access.
Yep, and if you just want a one-off deep dive right now, just drop us a super thanks.
Thanks. Okay, let's get started.
Right. Let's begin with Chapter 1, Business Understanding.
So the core idea behind TKO, it seems pretty genius, actually. Taking the scripted drama of WWE and smashing it together with the, raw reality of UFC. You end up with this premium sports and entertainment powerhouse. It basically dominates the whole combat and, I guess, simulated combat space globally. But what's really crucial for you, the listener, to grasp is their financial foundation, how it's structured.
Yeah, that diversification is absolutely key. They've got four main ways they make money, four revenue streams. The most stable one, that's media rights and content. Think multi-year deals, fixed fees for licensing UFC and WWE shows. That's predictable cash flow.
Then you've got live events. That's ticket sales, obviously, for over 500 events a year. Plus, they get these pretty lucrative site fees from the cities hosting the events.
Right, and the other two, that's where the margins probably get quite juicy. Sponsorships like logos in the octagon or the ring, and consumer products, the video games, T-shirts, all that stuff.
Exactly.
It sounds on the surface like a traditional media company, but you said the market doesn't see it that way.
No, not at all. And it comes down to scarcity. TKO reaches over 1 billion households. It has this near monopoly position. And its biggest value proposition to media partners like TV networks or streamers is that it delivers appointment television.
Ah, okay, like must-watch live stuff.
Precisely. When everyone else is struggling with people canceling subscriptions, churn, TKO offers reliable live content people have to tune in for.
So looking at the valuation then, this scarcity, it translates into a massive price premium, right?
Oh, absolutely. The PE ratio tells the story. A typical entertainment company might trade around, say, 30 times earnings. TKO. Its PE is sitting at a staggering 81.9.
Wow.
Yeah. That premium basically shouts that the market sees TKO not just as a media company, but as holding scarce, irreplaceable intellectual property, something that deserves a scarcity multiple. It's an IP licensing machine, not just a ticket seller.
Okay, that makes sense. Let's look at who's actually running this. Incredibly valuable, but as we'll see, highly leveraged operation. Let's move to Chapter 2, Management Evaluation.
The leadership team is definitely high profile. You've got Ariel Emanuel as CEO. He's known for being, well, the term used is very, very aggressive. He's the architect behind Endeavor.
Right.
And he's actually been quite open about how his own challenges like dyslexia and ADHD fuel his, let's say, inventive and ambitious approach to business. Then you have Mark Shapiro as COO, more the operations guy, bringing experience from places like ESPN, Six Flags.
Calling Ariel Emanuel very, very aggressive might be an understatement. I mean, this is someone who spots an opportunity or weakness and just attacks it. Great for growth? Maybe. But we're definitely seeing potential downsides in corporate governance.
Yes.
Our sources flag a major issue for minority shareholders, this related party deal. Can you unpack that?
Yeah, this is pretty textbook stuff for potential governance friction. TKO bought PBR, On Location, and IMG directly from its controlling shareholder Endeavor.
Cool.
The price was $3.25 billion paid in TKO stock. And that move, well, it bumped Endeavor's control up from about 53.6% to 59%. Critically, this was done without asking minority shareholders for a vote.
Right. And the market reacted immediately, didn't it? Stock dropped 5%. That signaled real discontent, even led to an investigation by Wolf Holdingstein, the law firm.
It did.
And that lack of transparency, it seems to connect with other issues, like talent friction. We saw reports, like from Kevin Nash, the WWE Hall of Famer, complaining about royalty payments being drastically slashed since the TKO takeover.
Yeah. Less transparent accounting, that was another complaint. It does suggest management might be prioritizing cost-cutting over maintaining relationships, maybe even with their core talent.
But despite these, let's call them internal conflicts, management is putting on a show of massive confidence with how they're allocating capital. It seems exceptionally aggressive.
Oh, it is. They announced a huge $1 billion share repurchase program that includes an $800 million ASR, an accelerated share repurchase that's designed to boost the stock price quickly.
Okay.
And at the same time, they doubled the dividend payout, doubled it to $0.76 per share.
Hold on, let me get this straight. TKO is taking on new debt to fund a dividend it seemingly can't afford based on earnings, while simultaneously dealing with a shareholder investigation over a related party deal. Doesn't that sound more like financial stress than confidence?
You absolutely hit the nail on the head there. That entire $1 billion buyback, it's being funded by a new $1 billion first lien term loan. That ramps up the leverage significantly. And that huge dividend increase, it pushes the payout ratio to somewhere between 125.6% and 140.4%. They are literally paying out more cash in dividends than they are earning in profit.
So they're borrowing or dipping into reserves just to pay the dividend.
Exactly. That's a major, major financial risk flag right there.
And all this high-stakes betting is happening while the company's actual efficiency, its ability to generate returns on its investments, is going down.
Yes, that's another critical piece. If you look at return on invested capital, ROIC, it was a pretty healthy 18% back in 2021.
Okay.
The latest trailing 12-month figure, it's down to 5.88%. Some sources even put it closer to 2%.
Going from 18% to under 6%, that's a massive warning sign. It kind of undermines the whole merger thesis, doesn't it? The idea that putting UFC and WWE together would create a more profitable company.
It certainly challenges that thesis based on current performance, yes. The synergies aren't translating to better capital efficiency, at least not yet.
Okay, let's pivot now to Chapter 3, Financial Analysis. What do the actual hard numbers tell us about the cash flow that's supposed to be supporting all this?
Well, look, TKO is definitely a cash machine. There's no denying that. Top-line revenue growth is strong. Q2 2025 revenue was up, 53.7% year over year. And free cash flow per share on a trailing 12-month basis is robust at $8.99.
Yeah, TTM, trailing 12 months. So, okay, they are generating significant cash, but how much of that is actually left after they pay the interest on all that debt?
And that is the catch. You see this big gap between their operating margin, which looks pretty healthy at 21.64%, and their net profit margin, which is way down at just 5.41%.
So most of the operating profit is getting eaten up by interest payments and other costs below that line.
Precisely. That profile suggests TKO is kind of maturing into a cash cow. It throws off a lot of cash, but it's struggling to reinvest that cash at high rates of return, which ironically sort of justifies management's decision to return cash to shareholders through buybacks and dividends.
Even if it's funded by more debt.
Even if it's funded by debt. It's a complex picture.
So the financial structure looks, frankly, a bit precarious with all that debt, yet the underlying business does generate a lot of cash. Which brings us right back to that massive valuation disconnect we talked about.
It's just extreme. That PE ratio, somewhere between 56 and 82, depending on the exact calculation. That's nearly triple the industry average of around 30.
Yeah.
We ran several educational discounted cash flow, or DCF, models, and the results were remarkably consistent. The current share price of $194.15 looks indefensible based purely on current fundamentals.
What kind of values were the models spitting out?
The fair value estimates kept landing in a range between roughly $104.48 and $152.34 per share.
Okay, so a huge gap.
A massive gap. To justify today's price, you need some really, really hyper-optimistic assumptions about future growth that, might just not happen.
All right, let's shift gears into Part 2, the assessment. We'll kick off with Chapter 4, Market Sentiment. Now, given these, let's say, troubling financial details, the high debts, the thin net margins, you might expect Wall Street analysts to be a bit cautious, but what are they actually saying?
Well, interestingly, Wall Street is overwhelmingly bullish. The consensus rating is a moderate to strong buy. You've got something like 14 to 16 analysts slapping buy ratings on it and precisely zero recommending sell.
Zero sells.
Zero sells. The average price target is hovering around $206 per share. Analysts seem really focused on what they're calling the compounding and execution story. They believe in the growth, especially the predictable part underpinned by those high-quality contracted media deals.
Okay, so the analysts love the story. Are there any cracks appearing in that bullish consensus? Any signals we should watch out for?
There are a few bearish signals, yes. One is the short interest. It's sitting at 9.13% of the float. Now, that's slightly higher than its peers, and it tells you there's a meaningful number of investors betting the stock price will fall.
Right. So not everyone is buying the hype.
Not everyone. However, from a technical perspective, the stock is in a strong uptrend. It's trading comfortably above both its 50-day and 200-day moving averages. So right now, the bulls definitely seem to have control of the price action.
Okay. Let's move to Chapter 5, ownership structure. Because this, you mentioned, is where we find perhaps the most critical contradiction, the insider conflict that seems to directly challenge the company's own narrative.
Yeah, this is, for me, probably the biggest red flag in the whole analysis. First, you see extremely high institutional ownership. Somewhere between 90%, maybe even up to 93% of shares are held by big players like Vanguard, BlackRock.
Which usually provides some stability, right?
Usually, yes. It shows confidence from the big money managers. But then you look at the insider behavior and it gets really weird. The company, TKO, is taking on $1 billion in new debt specifically to buy back its own stock, publicly stating that the stock is undervalued.
Okay, so the company's borrowing money to buy shares because they think they're cheap.
Right. But at the exact same time, literally during July and September of 2025, Director Nick Khan has been systematically selling large chunks of his personal shares.
Wait, the company borrows $1 billion to buy, claiming it's undervalued, while a key director is simultaneously cashing out his own holdings.
That's the divergence. It just completely undermines the public bullish narrative from the company. Why would a top insider be selling, taking profits, if the stock is truly such a bargain right now?
It doesn't exactly inspire confidence. The takeaway seems pretty clear.
It's pretty simple. Management, the corporation, is telling the market buy using borrowed money. But an insider, with his own money on the line, is effectively saying sell. That's a conflict you really need to pay attention to.
And we also can't forget the underlying governance risk baked into their structure, the controlled company status.
Right, we need to reemphasize that because Endeavor controls somewhere between 53.6% and 59% of the voting power. Minority shareholders have very limited say in major decisions. We saw that play out with that big related party acquisition earlier. Your vote just doesn't carry the same weight.
Okay, let's wrap up the assessment with Chapter 6, risk assessment. We'll look at the weaknesses and external threats TKO is facing. Beyond the governance issues and the debt load we've discussed, what other internal limitations really stand out from a SWOT perspective?
Well, the first obvious weakness is just the sheer height of the valuation. It demands near-perfect execution going forward. There's simply no room for error or disappointment at this price level.
Makes sense.
Then there's the aggressive, debt-fueled financial policy itself that's a major internal risk factor. And as we touched on, the biggest inherent risk unique to this kind of business is talent dependency.
Right. The wrestlers, the fighters.
Exactly. If the big stars in WWE or the top draws in UFC decide they want to unionize, or if key talent just decides to leave or gets injured, the core IP asset, the very thing generating the value, is immediately put at risk.
Okay, and turning outwards, what about macroeconomic forces? How do things like inflation or interest rates challenge TKO?
Well, rising interest rates are a direct hit. They increase the cost of servicing all that debt they've taken on. That eats into the cash flow that could otherwise, go back to shareholders or be reinvested.
And inflation.
Inflation threatens the live event side of the business. If consumers feel pinched, they might cut back on discretionary spending. That means fewer tickets sold, maybe lower pay-per-view buys, less merchandise bought at the events. That directly slows down cash generation from one of their key streams.
This brings up an interesting point about the potential indirect impact of those 2025 U.S. imposed tariffs. TKO isn't making widgets, so how could tariffs possibly hit them?
Yeah, it's subtle but potentially significant. The impact is systemic, it's indirect. Think about TKO's major corporate sponsors and advertisers, the companies whose logos you see everywhere. Many of those companies are directly impacted by tariffs, either on imports or exports. This squeezes their profit margins. And when a company's budget gets tight, what's often one of the first things to get cut?
Advertising and sponsorships.
Exactly. So budget cuts from sponsors could directly hurt one of TKO's four main revenue pillars.
And is there a longer-term risk related to this as well?
Potentially, yes. Think about their media partners, the broadcasters and streamers who pay billions for the rights to show UFC and WWE. If their advertising revenues decline broadly because of these macro pressures, including tariffs impacting their advertisers, well, they might be less willing or maybe less able to cough up massive increases in fees during the next round of media rights negotiations.
So it could eventually hit TKO's most stable and profitable revenue stream down the line.
It's a possibility, yes, a knock-on effect.
All right, let's bring this all together now in Chapter 7. Conclusion and really synthesize the bull versus the bear arguments for everyone listening.
Okay. The bull case, it really boils down to three core pillars. First, that unrivaled, scarce intellectual property the UFC and WWE brands are globally recognized dominant forces.
Right.
Second, it's fundamentally a reliable cash machine, especially from those media rights deals. And third, there's that predictable contracted growth that Wall Street analysts clearly love.
Okay, that's the bull side. Now, the bear case.
The bear case is just as compelling, I think, but it focuses much more on the fragility of the current structure. First, you have that sky-high PE ratio, over 80, demanding absolutely flawless execution, no margin for error. Second, there are severe corporate governance concerns because it's a controlled company. Minority shareholders have limited power. Third, you have that really worrying signal of insider selling contradicting the company's buyback narrative. Fourth, the dividend policy looks unsustainable, funded by debt. And fifth, that declining ROIC suggests the merger isn't creating the value hoped for, at least not yet.
So the final word on valuation, where do we stand?
It really hasn't changed throughout our analysis. The current market price, $194.15, is trading significantly, almost dramatically, outside the intrinsic value range calculated by our models, which is roughly $105 to $152.
So buying TKO today.
Buying TKO today isn't really a traditional value investment based on fundamentals. It's fundamentally a bet. A bet that the sheer power of the brands, the star power of the talent, and the momentum of future contracted growth will somehow completely transcend normal financial metrics. It's more of a momentum play right now.
That is a very high-stakes bet indeed. Okay, here's a final thought for you, our listeners, to mull over. Given this extreme dependency on the talent, the wrestlers, the fighters, and considering management's really aggressive financial strategy, how long can TKO realistically keep prioritizing these debt-fueled shareholder returns and cost-cutting measures, like those apparently reduced royalty payments, before it risks seriously alienating or even damaging the stability of its most crucial asset, the talent itself? It seems like a fundamental conflict brewing there.
That's a really good question to wrestle with. Well, thank you everyone for joining us on this deep dive into TKO. If you found this analysis useful, please do remember to like and subscribe to Stock Analytics AI. That gets you priority access to all our upcoming S&P 500 deep dives.
Yes, please do. And as always, just that crucial reminder. This analysis was generated by an AI system. It's purely for educational purposes. It should absolutely not be taken as financial advice. Always do your own homework, conduct your own research, or better yet, consult with a qualified financial advisor before making any investment decisions. We'll see you on the next deep dive.